Good Wednesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Bargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And, yep. I'm going to share my screen. As I'm doing that, a quick note to anybody joining us for the first time. Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, the analytics. If you have a question, you could type it into the live chat on YouTube. Will's watching it. He'll read it back to me. If you'd like to ask your question live, we also provide a link to Zoom on that live chat. Click on that. When you log into Zoom, click on raise your hand. We'll let you, once we turn you on live, you could ask your question directly. So to give a couple minutes for more people to join us and give you guys a chance to put in your questions, we'll start out taking a look at the pre-market report, see if we could get some insights on what's trading in the pre-market hours, and then we'll move on to questions. Okay, so pre-market report. These are stocks trading in pre-market hours. I'm going to scroll down here, and we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. I see 35 stocks made our percentage gainers list. 22 are on our decliners list. So from this perspective, right now, it looks like the trading in the pre-market hours has some bullish sentiment. Let's take a look at it from another perspective. I'm going to come back up to the top of the page. We have this calendar view and goes back days, and it's a summary of what happened in a pre-market hours from the top level. And today, September 20th, this is what's going on right now in the pre-market hours. We have 397 stocks trading higher, 206 stocks trading lower. As far as the volume, we have 178 million shares trading on up volume versus 45.8 million shares trading on down volume. And if we take that volume and convert it to dollar value, you have $1.3 billion worth of stock trading higher versus $505 million worth of stock trading lower. So that also indicates that the trading in the pre-market hours has some bullish bias. One more check, and we'll move on to the questions. I'm going to scroll back down to this list here, and we see that stocks that are in the list, some of them are low cap stocks, some are ETFs, leverage products. There could be preferred stocks in there. Any stock that's listed on the major U.S. exchange, if it's trading at pre-market hours and meets our thresholds, it can make this list. And to narrow down to a smaller group of stocks, we could use the filters above. I'm going to use this one in ETF. If you have a watch list, you could filter by your watch list. When you click on the filter, you get a drop-down menu to choose from. The top one, SPY. This one is the S&P 500 ETF. When we click on that, the list below will get filtered by stocks that are holdings in the SPY, which are the S&P 500 constituents. Here we have 5 stocks that made our percentage gainers list, one on the decliners. And this gainers and decliners list, there are certain thresholds it has to meet: liquidity, price move, volume, to make that list. But so far, the trading in a pre-market hours is indicating some bullish enthusiasm, some bullish sentiment. in that trading. So we gave it a couple minutes. Well, if you have some questions, I'll take the questions now.
No questions have popped up yet.
Okay. So
actually, Rob asked big day Fed announcement on interest rates. Someone asked, can we see that on the site where announcements like that may come up?
Yeah, well, for upcoming events under new, we have an economic calendar. And when you click on that, it shows you a calendar of major U.S. economic events that we're capturing. So today, here you could see here, these are the schedule of events that we captured, 2 p.m. interest rate decision. And you can see here, we're at 5.5%. I think that right now the expectations are that we're going to stay at 5.5%, maybe move up the next meeting if the inflation rate does not cool down further. But that's what we have captured on schedule today. So we have MBA mortgage applications, FOMC, and if you do click on it, this little arrow, this will take you to the website, so you could go the official website where these events are either there's a schedule there or they announce the event. It'll take you to the announcement. If you click on the topic, the headline, they'll take you back to our website with more details, showing you the historical data. So this is how the Fed funds rate has looked so far. We're up at 5.5%.
I'll tell you, a personal anecdote is relative to inflation. The price of gas at the pump is really affecting me again.
Right.
It's over $4 a gallon here at some of the stations.
Yeah. People are feeling that, and that feels inflationary, right? There's an argument that the gas is like a tax and it could slow down consumption, cooling off prices in other parts of the economy. We'll see, maybe not. So there, you could, even if you cool down demand and consumption, is productivity going up? Because if our productivity is declining, that will have an inflationary effect as well, right? So you bring down the demand, but if we're producing less goods, right? If our productivity is going down, if we have more shortages, that will still, and I think that's happening in the housing market, right? The housing market, the prices are going up, the cost of financing the house is going up, but there's a shortage of supply, right? So it's not, so even though you're cutting off some of the demand by price inflation, but we have a shortage, right? We have a shortage of houses for sale. That's keeping the what do they call it? The shelter inflation or the housing inflation. That seems like it's still rising.
Or at least steady, where you would think it would be falling, right?
It's either it's rising. Either prices are rising in some places, but if mortgage rates are rising, then
the cost of the home is
the relative cost of the home is, and if interest rates are rising, then and you're buying cash, there's an opportunity cost for moving cash from savings to the house. So it seems to me that that's still increasing, but we'll see what the Fed says today.
Yeah, we did have an options related question pop up from Jackie. Really appreciate it, Jackie. And he reminded me, he says, is there a difference? And Jackie, we answered your question relative to screening IV versus historical vol yesterday. I think you answered that question. I don't know, Jack, if you saw that video, sits on YouTube. So we talked about it yesterday, but he's asking, is there a difference between IV rank and IV percentile? If yes, what is the difference? He asks.
Yeah, so let me see if I could find an example here. So let's just use this example. It's the implied volatility rankings report. And when we measure implied volatility, right? So we have this right now. I'm going to go to a higher market cap stock. Let me just sort this by market cap. So now we have Apple, Microsoft. So when we measure implied volatility, here's an Apple's 19.3. The question for an IV rank, how do we rank it? Is it high or low, right? And what method do we use, right? Because there's no one method. You could come up with lots of different ranking systems for trying to figure out, is this high or low, and it's relative to what? Is it relative to realized volatility? Is it relative to where implied volatility usually trades, and where usually trades, how do you benchmark it, right? So first, there is no one right method, but we try to use some practical method to give us an idea. Is it on a high or low range, right? So that's what we're trying to do. Is it on a high or low range where it usually trades, right? Where does it normally trade? So here we compare it. There are 4 different ways to compare it. So here we could just look at the realized volatility in Apple. So this is the actual stock volatility in the last 20 days, the realized volatility, 26.2. Implied volatility right now is 19.3. So we could see that there's a big difference in where the stock has the volatility of the stock in the most recent 20 days versus what the market is projecting the next, month, right? Because the 30-day IV is what the market's implied volatility is for the next month, which is 20 something days in trading days, right? Then we could look at an annual volatility. This is the realized volatility in the course of a whole year, right? So it will be smoothed out over many more days, right? So you got 20 days, then you got volatility smoothed out over the course of a year, 27.1, 19.3. So here we have an idea that the market itself is forecasting the volatility going forward the next month to be below the realized vol. How else can we measure it? Well, where is the implied volatility usually, right? That's looking at the realized vol, the stock volatility. But maybe the implied volatility tends to trade below the realized volatility or above. So how do we compare it to where it usually trades? Where is it usually priced? So there are 2 methods here, and of course we could go out 50 methods, right? But there are 2 methods because we're just looking for a quick, practical way to try to figure this out, right? So this IV percentile rank, what is the percentile rank? Well, it'll look back to the last years of daily data. So in the last year, let's say there are 252 days of trading, right? And let's say the day before yesterday, the volatility was 19. The day before that, it was 18. The day before that, it was 20. The day before that, it was 25, and so on. So we have 252 days of observations in our database. And to see how, how we stand right now, the IV percentile rank is telling us what percentage of the days, were below this level. So it's not including, today. So it's looking today and then looking in the last 252 days, what percentage of the data, how many days out of 252 were below this level, right? So that's what this is, 10%. So what does that mean? That 90% of the days, the implied volatility was above 19.3. Okay, 10% of the days, it was below 19.3. So this gives you an idea where it is relative to the amount of days. Okay. Another metric some people like to use is taking the position of the current level, 19.3, relative to the lowest and the highest. Okay, so the lowest and the high. So you take just 2 points, right? The lowest implied vol in the last year, the highest implied vol, and take the percentage of the distance it is between the two. So here you're seeing it's 7%. Okay, so that's its position between the low and the high. It's a metric. Obviously, if you have like big outliers, it's going to skew it. So if you have a really high value in there, that's way away from the mean, way away from where the volatility is clustered. Usually this is going to get skewed, right? But you have the two to compare, right? So the percentile rank is a pretty good one because it tells you how many, really, if we distributed the data, and you guys probably, it's like the what do you call it? The empirical cumulative distribution function, right? Shows you the percentage of the data below the current level, right? So that's kind of how the IV percentile rank works. So you could see here, there's no, and we could keep going. We could compare it to 2 years. We could create more mathematical ways to measure that rank, right? There's no one way, but if you're looking at the 4, you pretty much have an idea we're on the low end, right? At this point, just looking at this, looking at the realized volatility, looking where implied volatility usually trades, looking at the high, low, we already have a pretty good idea. Okay, it's on a low range because here you're just getting a quick, trying to get a quick answer to a question, right? We could go analyze it further, but the idea here is like, all right, without having to go to the options chain and doing more analysis and stuff, give me, what is a quick benchmark that I could reference so I have a general idea, are we on the high end or low end of the range? So that's the difference between these two. Some people just use this position ranking. They just take the two numbers and say where are we next to the two. Again, if you have outliers in there, that's going to skew that number because you're only using two numbers, right? So you're using two numbers in it, but in the year you have 252 observations. So you're going to ignore all the other ones. And by using the IV percentile rank, you're taking the other observations into consideration.
Perfect.
Yep.
Thanks for the answer, dude.
Yep. Yeah. Was there any follow-up?
I asked Jackie if that helps. Any other questions, Jackie, relative to the IV versus percentile?
Yep. And I'll try to do so. These are good questions because it also gives me some ideas to maybe make shorter videos explaining some of these concepts, right? So we have like, we're talking right here, it's a half hour, maybe we could cover a couple, but these questions help. Thank you, because, I could go back and make shorter videos just focusing on, answering these specific questions. I'm going to go back, to yesterday's example, because I think one of the things we talked about was, well, how do we screen for implied volatility, right? Implied volatility that is trading below its realized volatility, right? Below the 20-day realized, below the one. And to do the screen first, I'm just going to do the screen. I think we just talked about the data, but let's just do an example of the screen. And we do have a lot of data in here, because what we have in here is different stocks with different expirations, right? So we're looking at the implied volatility of each of these expirations. We're not looking at a 30-day IV. 30-day IV is a synthetic 1 month option, right? Here we're looking at the actual expiration. It could be, the expiration could be in a week, it could be in a year. And those expirations have their own at the money IV. So I'm going to do a screen here. Let's look for longer term. I think we're looking for leaps that have 60 days or more here. So I'm going to look for expirations that expire 60 days out or more. Okay. And just to narrow it down further, let's look for option expirations that have some volume, right? So if it's like zero volume, if there's no trading, we're just going to assume that the markets might be just wide in there, and let's look for places where things are trading. So I'm going to put the minimum option volume, and let's do it over 1,000. So now we came back with stocks that and expirations that traded at least 1,000 contracts on the day. Right, so now we're still narrowing it down. We still have 800. Let's maybe narrow that down a little bit further. Maybe go for higher market cap stocks. Let's do 20 billion for now. I'll do 10 billion. Let's see what that does. All right, still narrowed it down to 548. So let's do this. Now we want to see where the implied volatility is trading below the realized vol, right? So let's do the 20-day first. So the at the money IV versus the 20-day, right? Let's say it's trading at least 15% below. So now we narrowed it down to 21. Now we have where the implied volatility is lower than the 20-day, right? 26.5 is lower than 31.3 by at least 15% or more. Okay. Let's go a little bit further. Let's see if we can narrow it down. And let's say that the implied volatility is trading below its 1 year, right? So this now we expanded the data now to 1 year, and it's trading below its longer term trend line. And I'm going to click on this, and let's give it at least, let's say at least 10%, okay? Because I already have 21, so let's see, so 17, right? So now we have 17 different expirations. So you could see Apple has a couple of them. December 15th, January 19th, Tesla has a bunch of them, okay? Where the at the money implied volatility in December 15th expiration, right? So remember, this is looking at December 15th expiration, it's 21.9. Apple's January 19th, 24 expiration is 22.2. And then it's comparing it to the 20-day and the 1 year. And you could see here, This is 16% below the 20-day, 19.2% below the 1 year. And that's a quicker way to screen. I don't think we did the screen yesterday. We just talked about the data. And if you and I guess we can actually narrow it down by the bid-ask spread. So if we took the at the money option, we could say that I want the bid-ask spread to be under 25 cents. So now we narrowed it down to 12. Okay, so some of these leaps might have more wider spreads. If you like this screen, let's say this is the screen that you typically like to check, right? And you want to go back, you can save it. So you could save over here. You could say save new preset. If you give it a name, I'm not going to do it now because it's going to save it to mine, but give it a name, hit save preset. Once you do that, it'll be in here. Okay. And then you could go back throughout the day, check if anything new pops in, because of course, implied volatilities and markets are changing, they're moving around. But what we did here was first, we tried to narrow down based on the liquidity measures. Is there volume? Is there trading at least in this expiration? We put in minimum volume. I put in a market cap here to go for a little bit higher market cap. If we also put in a bid-ask spread a maximum amount, 25 cents. And then we set the filters for how far below the historical vol are we seeing the at the money IVs, right? So at the money IVs below the historicals.
Dee, can you just walk through how you got to this page?
Yeah. So to get to this page, it's under screeners, options by expiration. All right. And maybe I'll do like a video with a shorter, quicker explanation out there just for reference.
Rob had a suggestion. It would be great to have a link to the short video on the web page so you could go directly to it. Something for the correct video. It's hard. He's saying at times it's hard to find. Do we have
that's a good idea. Maybe like a library for each report.
Yeah,
so that could be a good idea too.
Because Mike also said he likes to read about it and he likes reading numerous times. So
okay.
A description. I know there's a description in the video on YouTube a lot of times. And I do throughout the site, we do have videos attached to different reports and stuff. Sometimes it's hard to find and it's not with every report, but there are videos.
Yeah.
So, but that's a good suggestion, Rob and Mike. Thank you very much. We're right up against the opening. Great job, Dee.
Yep. Thanks everyone for joining. Thank you for the questions. Hope to see you guys tomorrow's Thursday.
I just noticed I apologize about this, Sean. We had a question that popped up on the Zoom. It didn't alert me. Now that I'm ending it, it popped up. And I'll copy that question down, Sean. He was asking about a UNH strangle. Revolves around direction. He said he can ask it live. Maybe we can do that tomorrow, Sean. If you come on, I'll watch right away and I'll copy that down so Dimitri has it so he can take a look. So if you come tomorrow, we'll get you on first thing, Sean, live. I apologize about that.
And
awesome job, D.
Yeah, Friday I'm out, Will. So Friday morning.
Friday we don't have Dimitri, so we'll be off Friday, everyone, for a long weekend.
Yep.
All right, my brother.
Everyone,
thank you very much.
Thanks for joining, everyone. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
Have a great day, Chameleon.